Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyce-Noe with my co-host Kevin Casey, and today we are joined by Ken Bates with LO Autopilot. LO would stand for Loan Officer, just in case you didn't know. So, welcome everybody. So happy you're here today. It is a huge week for economic news. Huge. So this morning I was looking at the 10-year. Remember when we were talking about the 10-year, which I don't know, in January is 480. A couple weeks ago it was 380. Then it went up to 450. And then last week I was remarking on how it was headed back down. And today I looked at it this morning, 418. Then I looked at it again, 417. Then I looked at it again, 416. I mean, progress. We'll take it.
Yeah,
We will take it, right?
slowly down.
It might be perfect timing for Ken being here and what he has to offer. So on Wednesday, we will have ADP because it's jobs weeks, kids. We'll have ADP. They're expecting 108,000 job creations. We're going to have Q1 GDP, which they're expecting to come in with a negative sign in front of the number. And then we are also going to have PCE, which is the Fed's favorite level measure of inflation, personal consumption expenditure, and they're expecting that to be close to flat. So cross your fingers and hope that it's something that will make the bond market happy. Thursday, we'll have initial job claims. And then Friday, we have BLS, my favorite, as you know, Bureau of Labor Statistics. So we'll see what nonsense they've concocted this month. In other news, just remember we are part of the Chrisman Commentary lineup, and make sure you're checking out his commentary every day and the other shows that they have to offer. On May 15th in Greater Ventura, in Thousand Oaks, Greater Ventura Camp is going to have their lender fair, which is great. It's always lots of fun and very informative, and they have a wonderful lunch. And then we have Camp Legislative Day next week. That would be, I think it's the 6th or the 5th, or oh God, Jason's going to kill me.
And that's in Sacramento.
That's next week in Sacramento. And I think we have noticed that it really matters what is happening at the regulatory and legislative level. So if you can join them in Sacramento, please do. So again, it's jobs week, and we've had some pretty decent news thus far, including JOLTS, job openings and labor turnover, just in case you forgot the acronym, Kevin. We are down 300,000 jobs from last month, with February also being revised down another 100,000 jobs. So we're down to 7.19 million jobs. Remember when we had 12 million jobs on this report, Kevin?
No, but those still crazy numbers to be adjusting by.
I
I mean, a
And
typical jobs report is around 250,000 jobs were created, and you're saying how many jobs were not
well,
created?
this is JOLTS though. This is the job openings and labor turnover. And we've discussed how this could be flawed because we could have double postings in other states, and some of them are fake and God knows what, and who
And
the hell.
different titles for the same job, and then some
Right.
companies
Exactly.
post openings even though they don't have openings because they want to look like they're prospering for the S&C. And where did you disappear to?
Well, I just realized that I had not made it so that Ken was going to be able to share a screen, which at some point he's going to request to do. Then I'm going to be sitting here looking stupid, and it's just a thing. So just, yeah. So with all that being said,
Well, since we haven't quite jumped off of the jobs report, just a quick question. Did Trump change who's in charge of the jobs reports? I forget, because there was about a year ago, there was a new person put in charge, and she immediately adjusted a lot of the numbers, if you remember right. And I'm just curious if she's still in charge, or did Trump switch her out?
I do not know anything about that at all. So, I mean, if you know me, if I were in charge, that would be the first thing I would address is the jobs numbers.
So wait. So let me get this right. So Audrey becomes president of the United States. The very first thing she's going to put, and who are you going to put in charge of the?
I don't have anyone identified. Definitely not you. You can barely count to 10 without taking off your shoes, but okay, that's not actually true.
I'm thinking maybe Elliot Eisenberg or Lawrence Yun. What do you think? Or
I don't know. I'm gonna have to think about it. Anyway, we'll speculate later. I literally cannot find the button that says share screen. Kevin, can you see it on your end?
yeah.
Okay, great. Can you enable it so that Ken will at some point be able to share his screen with us? Or we'll be able to share our screen with him? I swear I meant to
Oh,
do.
no, it only says I can request you to allow me to share
Okay,
the
Ken,
screen.
you request it. Hopefully something will pop up on our end. All right, that's enough of that. So with all that being said, I just want one more thing. I just have one more thing to say before we get going with Ken. There we go. Allow. Hallelujah. So thank God someone knows where the buttons are. Okay. Do you remember
And how to push them. That's the other part.
That's very important. Yes. So, does anyone remember me ranting and raving about LLPAs ever? Probably not. Um, the
Wait, yesterday, the day before,
exactly.
last week.
Yeah,
Yes.
exactly. So the second home and investment property LLPAs went into effect a couple years ago because it was supposed to help them bolster their ability, the GSEs that is, to, okay, hang on, I'm gonna read this from here so I don't screw it up. And this is from IMF Public Pubs. When Federal Housing Finance Agency, that's FHFA, in 2022 sharply increased loan level pricing adjustments on second home mortgages delivered to the GSEs. One of its goals was to boost access to credit for first-time homebuyers and low and moderate income borrowers. According to a new research by the Consumer Financial Protection Bureau, it didn't turn out that way. So these economists got together and they looked at the LLPAs on second homes specifically. Oh, and investment properties. Okay, there were investment properties in there. So with all that being said, it increased the amount it took to pay for that loan, the cost of the loan. But that kind of lending decreased 23% at the GSEs. I don't know about you. Kevin, have you done a conventional investment property or second home in recent
Yes,
history?
I have. I did investment property. But I ended up doing it, now that I think about it, did not do conforming. I went with the SCR.
I rest my case. Okay, so I have done exactly 0 investment properties since they've implemented these LLPAs with the GSEs, and I have done 1 second home, one, and they had an LTV of like, I don't know, they put down like a buttload of money. So, I mean, humongous amount of money. So their LTV was tiny, their credit scores were super
This
high.
property was in Walnut Creek. They probably purchased it for 5 million and they
It
put
was a
down.
second home and it was down, I don't know, somewhere Pacific Grove or something like that, near the beach,
Okay, yeah.
down
Well, a
there.
$5 million purchase price, and they probably put 4.5 million
It
down.
was a very reasonable 1.3 or $4 million, and I think
A
they're looking at
shack.
500. So yes, they did put anyway. All right, moving right along. My point is, I rest my freaking case. I knew these LLPAs were a terrible idea. I knew they were excessive. I had a bad feeling they were going to impact everything negatively. And now I got to check out these economists, but it sounds like it wasn't great. So, with all that being said, Ken, I would just like to say welcome. So, we've known Ken Bates for many years. His wife is one of my favorite people on the face of the earth, Karen. And if you were wondering why it looks like he is coming to you from the 3-year-old's room or the 8-year-old's room with all the fighter pilots behind him, Ken, tell us a little bit about your background. Why are all those fighter pilots there?
Because after dragging around all my happiness from being in the military, I finally, for once, have the I love me wall at my house. So, yeah, spent 20 years in the Navy, flew an F-14. If you saw Top Gun, I got to be Goose. So life was a lot of fun there. Did really neat things, went to test pilot school, got to fly helicopters and jets and old jets and new jets and lots of fun things where my job was to translate between what the developer says and what the user says, because people are like, I want this, and the guys that develop it are we don't speak English, or at least not normal people English. So it's like, how do you straddle both? So it was a fun life, and yeah, I got to do that. And for everybody that wants to know, yes, life is better upside down at 30,000 feet doing Mach 2. It's rather dangerous and everything else. And yes, I do miss the flying part. No, I do not miss the hours and hours and weeks between.
You know what?
I got a quick question for you, Ken.
Yeah.
Is it possible to tell whether your airline pilot was a Navy guy or an
Oh,
Air
boy.
Force guy based on how he lands the plane?
Yes.
That's what, okay, then just want to make sure, because I've heard this story, that when your Navy guy lands a plane, he tends to slam it onto the runway versus the Air Force guys, they tend to come in nice and smooth. Am I getting that correct?
Absolutely, because when you're on an aircraft carrier, your job is to stop on this dot. So you have to go like that. You don't get to go down and then go flare, 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 eventually touch down because you still got 2 more miles of runway.
I was flying from Scotland, from Edinburgh to Dublin, Ireland, and it was a rough flight. The airplane sounded like it was just a weird flight, very weird flight, and not smooth at all. And so I had just gone through this whole thing with the, what do you call them now? Not stewardess, flight attendant. I had just told the flight attendant, I said, what do you think? Do you think this is a Navy landing or an Air Force landing? And I had walked him through. I said, okay. So, and he's like, what? So I told him the whole thing about how, anyway, so we go to land in Dublin, and I swear to God, no, Navy.
Yep.
Anyway, okay, moving right along. So with that being said, I think it is just remarkable. Knowing Ken, like we know Ken, he is the most mild manner, calm, like he could just lull you to sleep. And think of him flying an F-14 and being upside down at Mach, whatever the heck you just said, is amazing. So
Wait, before you go any further, I have another question. Did you ever eject?
No.
Good answer.
and you miss it or no?
The flying part, yeah.
Yeah.
And the problem with the flying part is you get spoiled. So, there were flights that I would go on and it'd be like, that was boring. All we're doing is touch and goes. And it'd be like, okay, how do I get out of this flight? And then you meet up with people afterwards that give you the proper perspective again of, do you realize what body parts I would give up just to be in the back for touch and goes, you spoiled brat?
And just for the record, my very first airplane landing was a touch and go.
Okay.
To be clear, he was in the passenger seat. He was not flying the plane.
Yeah, definitely wasn't
Okay.
flying the plane.
So he went from the military, and then he became a loan officer who focused on
Yeah.
VA. And he has taught the veteran certification for NAM a million times. And he is, I mean, your focus with your company and when Karen was working with you was VA, VA, VA. So when you were a loan officer, you closed a few loans, right?
Yeah. So with the focus on VA, we were 92% VA going all the way back to 2006 is really when we switched that focus. We started the company. She started the company in 2004. I was still active duty. So we discovered we were in San Diego. The military dropped me off there. And at the time, every other loan made sense because you could do a 5-1, something, something, no doc, blah, 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 easier, faster. Nobody knew how to do VA. So we started doing VA, started teaching VA classes, and we were trying to teach them to borrowers. And what happened was real estate agents kept showing up and going, I want to know about these things. So we switched our focus, started teaching them to real estate agents. And then in 2008, 7 and 8, the mortgage meltdown happened. And all that was left was 20% down conventional FHA and VA. And since FHA works for everybody, all the banks and everybody else was like, I need to learn this thing. And we were already up to speed on VA. So while everybody else was going out of business or watching the implodometer, we were literally, Karen one day was crawling under her desk because the phone was ringing faster than she could keep up with it because we were the VA specialists. Now, the downside of being focused on VA back then was they didn't have the rules on seasoning. So we would do a VA loan at like 101 pricing because the clients needed all of their costs covered as much as possible. And 3 weeks later, somebody was coming along and trying to do a streamline refi at 98 pricing. And the clients are like, that's what I wanted all along. Why couldn't I just get the lower interest rate and build all this into the loan? It's like, well, we can't do that because we just can't do that. So I'll refinance you as soon as I can, which of course there's early payoff issues. So we learned very early on, what do we have to do to defend against early payoffs? How do I keep that client from refinancing with somebody else for those first 6 or 7 months until I can do it and take care of them and make them happy? So that was one of the first hurdles that we had to overcome, is how do we keep those clients loyal and in front of us and not answering the junk mail that, let's face it, I think the people from the timeshare industry, the ones that you walk in and say, there's no chance we're doing anything. 60 minutes from now, we're walking out with our coupon. And 58 minutes later, you're looking at your other and going, what do you think, honey? It's like, what do you mean, what do I think? How did we go from there's no way, that we're ever doing this, to what do you think? That's some damn good sales tactics. So those junk mail people 15 years ago had some damn good sales tactics that will get people to call. And nowadays, with AI and servicers getting smarter, oh boy, it's just a craziness.
Well, that's one of the reasons that we're having you on today, is because we are hearing more and more and more about how aggressive the servicers have been. And historically, they've been terrible at retaining their clients. They've done, 17 to 21% for the numbers that we had been hearing before. And now we're up to, I think you said yesterday that Mr. Cooper is claiming that they're keeping 40%. Is that
78?
Sorry?
70% they have $1 trillion servicing. So this is from the head of production back in September last year. Of their $1 trillion of servicing, of the refinances that are being done in that servicing, 78% of them they're doing through their retail arm of Mr. Cooper. Wow. So even though everybody is like, I don't like my servicer, and let me have a better experience, somehow they're there first, and they're being successful in capturing that much of it. And worse, they're building it into their servicing pricing, because they're like, I'll pay more for these servicing rights because I think I'm going to refinance 78% of them once, maybe twice, maybe some of them 3 times. So they're already planning for it.
So they flipped the numbers then. And what we need to be really aware of is they're already on top of our clients. And again, I've had borrowers call me and say, I have Mr. Cooper, I hate them, I want to refinance and have a different servicer. And I'm like, you can't do that. Your rate will go through the ceiling. But with that being said, at some point, there will be a time and place where you are going to want to refinance. And actually, we could maybe be headed there now for some of our borrowers. But again, it is, you've got to have a way to track it. And a lot of LOs have gotten very, very complacent when it comes to being on top of their pipelines and their databases. And they are so used to just the phone ringing and the emails coming in and the requests just coming to them. And they're not doing much to stay in touch and forward reaching to the borrowers. So that is where you come in. So why don't you tell us a little bit about what you have, Loan Officer Autopilot, and tell us how that works.
Okay. So again, my background originated from 2004 to 2020, focused on VA. So obviously a VA streamline refi is pretty straightforward. And one of the things that we did back, earlier than 2012 was, hey, rates dropped one day, and it's, well, what would it take to refinance these people? Well, let's go crunch the numbers. And we all know how that goes. It's like you look at your client that you did their loan 2 years ago and go, okay, what would their balance be now? What would their value be now? Fortunately for an Earl, I didn't need to think about that, but what's their value? Okay, their balance is down to this, what's all their credit and everything else. So what pricing could I get them? Okay, with that pricing, how much would the fees be? Okay, I gotta go get some estimated third-party fees. All right, how much does all that add up to? So my new loan amount needs to be bigger than my estimated balance by that much in order to cover that, because let's face it, they don't want to bring a check to close. So, okay, if my new loan amount's that big at this interest rate, then what's my payment? How's that compared to the old payment? Hey, does this make sense? Ooh, I can save you $100 a month. Oh, but it's going to cost $12,000. Maybe that loan doesn't make sense. Let me go do this process for client B. Hey, I can save you $200 a month, and the costs are going to be $1,000. Holy crap, I should have called them 2 months ago, because this is pretty much a no-brainer. So you go through that process, and let's say it takes 15 minutes to 30 minutes per client to crunch through all these numbers. And you go through, the first refi boom we did, I forget what we did, something like, 30 clients. It took me almost 15 hours to do all that, type up the emails and say, hey, Mr. Client, this is what I can get you. And the next day, some of them responded and said, that's nice. What's it today? And now I got to redo all the math. And some of them said, yes, let's do this. And we had our first, refi boom. And it's like, well, that was a lot better than doing purchases because those were easier. And, this is that repeat customer, that thing that, we always look at every other industry and go, wouldn't it be nice to have repeat customers and we don't have to constantly be out trying to feed the engine? So it was like, this is great. So I systematized that in basically a spreadsheet and said, how do I make it so that I can get this down? So let's fast forward to 2016, Brexit happens. For those of us that are old enough to remember, that's when the British said, we're out of the European Union. Interest rates dropped like 0.5% in a day and a half. So I had everything systematized. So I had my whole pipeline of loans that I closed since up to 2016. Within half an hour, I had quotes for all of them out, and they were all coming back. And in a single month, I made in excess of $400,000.
And that was 2016 loan amounts.
What's that?
2016 loan amounts.
2016 loan amounts. Now, admittedly, I was in San Diego, so that did help a little. If you're in South Carolina, I used to be the producer for volume. My another guy in the bank was top producer for units, and he always just was like, "It's not fair, man. I'm in like the hills of South Carolina. I do twice as many units as you, and you do twice as much volume as me." And I'm like, "Yeah, that does. I'm glad it's me and not you." So.
Yeah.
Okay, I just want to stop for a minute. And because I have been beating the drum that we have got to be focused on purchases. And I know that your wife was very involved in a few organizations and definitely out there beating the bushes to get purchases. So
Yep.
I don't want anyone to think that that wasn't something that you thought was important or think that we're endorsing a refi only model, which eventually doesn't work out, say the last 2.5 years.
How do you stay focused on purchase without losing refis? Because that's the challenge. Is you're sitting there looking at rates right now. You listen to you guys or anybody else, and it's like, at what point do I go back and mine my database and do all this math? Do I do it this week? Do I do it next week? Let's go back to last fall, summer, fall, where rates were dropping. July, August, September, coming up on the Fed announcement. It's like, hey, you know what? Refis were starting to ramp up. So it's like, do I check all my stuff in the middle of August? Do I check it in the middle of September? Do I check it every day? It takes a lot of work, and that takes you away from, playing with your kids, doing your purchase business or whatever it happens to be. And if you're not doing it, then the worst thing possible happens. You finally get around to it. And you call up your client and say, hey, I can save you $200. And they go, I know, I did it a month ago with my servicer. And it's just like, another one. And statistically, according to Total Expert, only 20% of loans are refied with the loan officer they came from. So 80%, and this is before AI got smart and servicers got aggressive, 80% were swooped up by either direct mail people, servicers, or just other people that were there sooner, faster, better, whatever it happens to be. So if you're not there answering your client's question of, can I refi, and somebody else is, you're probably, how loyal are they? So that's the challenge, and that's what we were trying to overcome, is how do we make it so that you have the relationship advantage? Your clients hate Mr. Cooper. They like Audrey. So it's like, you should have first right of refusal on any refi. If somebody comes along and says, hey, I'm going to refi, it should be, I'm going to go back to the place I know, like, and trust. Even if it was just an average experience, it's like, I'm not going to go to a stranger where it might be a horrible experience. You have the relationship advantage. So why is it all these loan officers keep losing that advantage? It's because they're not staying in front of their borrowers. Somebody else is getting there first.
So how did you do it? How
So,
do you do it?
so what we did was we simplified things. And for those of you that are listening, I'll talk through this. But what we did is we started sending out a monthly email that just said, if I can get over the right screens, does it make sense to refinance in a simple, hey, stop that. Does it make sense to refinance in a simple stoplight chart? You know, hey, red, yellow, green. So something that a borrower can look at and go, am I in the red? Am I in the yellow? In the green? So every month on the first of the month, we would send something out that says, hey, by the way, you don't make sense to refinance. Talk to you next month. And the next month, hey, you don't make sense to refinance. You don't make sense to refinance. Hey, you're getting closer. Oh, we moved back into the other direction. Hey, you got closer. You know, just looking at people as they go through and going, hey, who makes sense here and what can we do for them? And then when they do finally make sense and we track it over time, hey, you finally moved into the green. I can identify that down to the day because the system is watching it for me. And it's doing all of this, and then it's pushing that information directly to the client. So that way, you as the loan officer, you're out of the loop. It's called autopilot for a reason. You know, the pilot is there to take off and land. Everything in between, you don't really think the pilot's up there actually touching the controls. He types in a button, or he says, follow this route, or he says, go to this altitude. And then he goes back to watching, you know, Netflix or reading a book just like everybody in the back of the plane. Now, admittedly, once a flight, he might get on the radio and be like, hey, everybody, we're on time and out there's Albuquerque. You know, it helps to check in once every now and then, but the system is just sending it to him every month. It's not cookie recipes or it's time to change your smoke detector batteries. It's actually answering the question the clients want to know of, can I refi? You know, how much can I save? Does it make sense? So it's looking at all that and literally going on a day-by-day basis. You know, we're looking at an example here of Clint Branch. You know, what can you do for him to, you know, refi on each day of the week? And looking at each one of these people to go, what's happening with them? Or you look at somebody that's, you know, a little bit farther along and it's like, okay, you know, and what happens is it's looking at them each individually because there's ways to mine your database. You could go in and say, I'm going to set a trigger for everybody that is 0.75% over current market index, which is what some systems are built for. But the reality is, well, what if you're a big loan or a small loan or anything else? So we're looking at a sample database of some loans. And if I look at this and go, okay, let's look at all these loans and sort them by interest rate of, you know, highs to lows and go, you know, my 8.5% loan is in the green. Giant surprise. My 8.34% loan is in the red. Why is that guy in the red, but the other one's in the green? It's like, okay, it's probably because this one's in Tennessee. It's probably an investment property or something like that. You go down to the people in the 7.5s. And it's like, this one's yellow, this one's yellow, this one's yellow, this one's red, this one's yellow, this one's dark red. And then we got a 7.25 that's dark green. How is it this lower interest rate at 7.25 actually is a no-brainer refi where the guys up at 7.5 are yellow of, you know, they don't quite make sense yet. And it's all those little nuances of credit scores. If anybody does loans in Florida, you know that the transfer taxes, you know, like this guy's in Florida. The transfer taxes are like $6,000. So you got to save a lot in interest rate to justify those extra costs. So that's why he's probably yellow. Whereas if this property was in where you guys are in California, he probably should have refinanced a while ago.
Wait, hang on. In Florida, you have transfer tax on a refi?
Oh, yeah.
Holy
Really?
guacamole.
I know New York has a
Yikes.
refi tax. If you refinance a loan in New York, it's 1%.
Now, if we look at this loan, so he's a $488,000 loan, and his closing costs, this is pulling in real third-party fees and everything else. His transfer taxes are $2,600. His title fees $2,500. His settlement's $1,300. So it's like, holy wow! Just between third-party fees, that's pushing $6,000.
Wow.
Wow.
So you take the same, you take somebody else that's a very similar interest rate that's, I don't know, let's pick one that's Washington, most of these, let's try somebody that's in Washington. If we view his loan and go, what's up with his costs? Like, all right, his third party fees are 700, 1,300, probably about 2,500 bucks total. So that makes a huge difference.
Yeah.
Just the size of the loan makes a huge difference. You get a really big loan, those $1 million loans only need to save 0.25% to justify the costs, whereas a $100,000 loan, you need to drop like 1.5%, 2% to just justify processing fees.
Mhm.
So the fees are all, you're already hooked into a system to auto-populate those into this system, right?
So it's pulling in an estimated value, AVM, and that's something that the borrowers get to see as well. So they get to voyeur and see what their value is. And before you ask, yes, all AVMs have their challenges. So I've tried 6 or 7 of them. None of them are perfect. And that's where you as the loan officer, when we have people that are here, we'll have somebody that the system will look at them and say, hey, you know what? I have you as just barely in the yellow. There's a reason they're just barely in the yellow, is because it's looking at them and saying, let me grab somebody that's just barely in the yellow. Somebody like Ruby Johnson. You'll notice it says value needs to be at least 530. And right now it's estimating her value at 460. So what it's doing is it's going through and saying, I could do this refinance for you, but we don't have 80% loan to value met yet. So I don't want to show you that you're in the green. Let me leave them in the yellow because it doesn't make sense. And once a month it gets an AVM update. So as soon as that AVM says, hey, you're in there, she's going to jump from the yellow to the green. You're going to know it that day. She's going to know it that day. And life is good. Or you as the loan officer could come in and look at this. The borrower could do the same thing. They get their own access and go, my house is worth $530,000. So let me update my value and override the system. And at that point, they'll say, okay, from now on, we're going to assume you're higher. So instead of, going up and down, you're going to be doing that. And let's do this loan. So that way it empowers both you and the borrower to go, well, do I meet this? And if so, then let's make it happen.
So show us how it looks on the borrower's end. What do they have? Do they have a website? Do they have an app?
Yep.
Both.
So they have a website. We don't have an app yet. That's where what the borrower sees, and let's assume that they're on a phone. So this is a mobile responsive website.
Okay. This is a website on a phone.
Yep. So
okay. Got it.
This would be, what Safari would look like on an iPhone 15 Plus.
Okay.
So I'm logged in as Matthew. He's got his property at 726. He actually has multiple properties. So if you have somebody with like 6 properties, they get to see them all in one place.
Okay.
And simple things that say, hey, your value is down, your rates are up, boo-boo. They can look at value. So, hey, what's going on with my value? It's 691. You can see that it's been going up and down. So it's similar to other systems. People can go, watch it once a month and go, what's going on with my value? Or they can come in and go, what can I do as a lower payment? I can save $477. But it says not yet. Why does it say not yet? Well, currently you got a couple options. Option number 1, don't refi. Option number 2, I can get you a 6.5% loan. It would save you $477 a month. And that makes sense if you keep the loan for 3 to 30 years. Well, why is that? If the borrower looks at the details, they're going to notice that the closing costs are $21,000. So that's why it's not yet, because that's not a very good, in order for that to be a net benefit to the borrower, they'd have to keep the loan for 35 months, which is what positive point is. When would this be of net benefit to the borrower? So they can look at that and go, hey, you know what? If I kept the loan for 1 year, wow, that's a $15,000 negative number. That would be a dumb refinance. If I kept the loan for 2 years, if I kept the loan for 7 years, ooh, now I'm making $39,000. So this is where the client's looking at it going, should I wait? It's like, yeah, you probably should wait until rates drop a little bit more. So that's where, you can look at that. Or Matthew can look at his other property where that one's on Northeast Street. And it's like, okay, what can we do here for this loan? And you'll notice it says seasoning, May 20th. Seasoning rules limit me from refinancing you until after that date. So that way you're already telling the client, you know what, I'm going to be watching that. Oh, by the way, we're inside of May 20th. So the system is built around lock periods and everything else. So you would be sending him something that says, hey, you know what, if he was in the green, you could actually lock him right now. But in this case, it's just giving them that, setting their expectation of, yep, this is when we can do something. And oh, by the way, I could drop you, it'd save $390 a month. But again, costs are crazy high. And it's looking at every interest rate possible and then going, which one makes sense to show the borrower? So like some other tools that you have to crunch through, it's doing it for you and going, hey, which one of these things should I choose? And often it will choose two different ones. In this case, it chose 6 1/4 and 6 3/8. But a lot of the times it's going to choose a really low interest rate that's going to make sense for really long term, and something that's a much lower cost that's going to make sense if you keep the loan for a shorter period of time, giving the client some choices, but not overwhelming them with, hey, here's the 9 things I can give you, and here's all the numbers that go with them. Now you, Mr. Client, who don't speak this language, if you're not overwhelmed, you can just guess and throw a dart. But if you are overwhelmed, we all know that a confused buyer doesn't buy.
Yep. Yeah, I learned a long time ago, just offer them A or B. If you go for A, B, C, and D, you get 0.
Right. And they can also go in and see what their trend is of, hey, you know what? What's going on with me? So you get that borrower, let's say it's September 21st, 2024. And the Fed's just about to come out with their announcement, and everybody's sitting on their fence going, you know what? I could refinance you right now, but you want to wait, don't you? Because you heard the Fed's going to lower interest rates at least 0.5%. And the Fed lowers the interest rates, and your clients go, well, what was the impact? And you go, well, let me go crunch all the numbers, and rates got worse the next day, and the next day, and the next
day, and the next day.
To December and January.
Yep.
And you're having to constantly call your borrower and say, you missed it. This way the borrower can just log in the next day and go, crap. At what point do I stop leaving my chips on the table and saying, let it ride, let it ride? At what point do you just look at it and go, all right, I'm in, I want to jump on this, at which point the borrower can just jump down here and say, yes, I'd like to refinance. They click that button and an email immediately goes to the loan officer that says, Matthew would like to refinance at 6 1/4%. Here's his phone number. Here's his email address. So it's, you don't even really have to land the plane at that point. The plane's, already on deck. All you got to do is set it up for processing. Now, this is a quote generating system. This is sales assistant. So they still have to qualify, but let's face it, if you can save somebody $390 a month and they're currently on time with their mortgage, who doesn't qualify for something that's cheaper? So yes, there will be those times that you get the one person that's, I trashed my credit in between. But Matthew could come up here and he can change his stuff and say, you know what? I'm not a 655 credit anymore. I'm a 620. I did trash my credit. I want to get realistic numbers. Or no, I'm a 755 now. And if he updated that, it would rerun all the numbers and go, pull in all new pricing from your pricing engine and redo everything and instantly give it to him. He's not calling you at 6:30 at night and saying, hey, what would my numbers be? And you're looking at your loved ones across the dining room table going, okay, I either answer this text right now or he Googles somebody else, or I don't answer this text. Either way, the people across the table are already giving me the evil eye going, well, what's it going to be? And I'm in a lose-lose situation. This takes you out of that lose-lose situation. It gives you back your time. So you can go focus on purchase business and know that your entire pipeline is on autopilot and your clients can know it too.
I know the people sitting across that dinner table from you, and I wouldn't answer the phone either. So no wonder you figured out how to do it this way. That was very smart. So the credit score is pulled from the last transaction you did with them. Is that how that works?
Yes, right now we're pulling in a CSV import for all your loans, so it's just going to be whatever you export from your system, and then yes, you can update it, but just about everything. The goal of this is to be easy. While it's sophisticated and fancy and down to the penny, even this really nice website that you as a loan officer get with all this pretty dashboard, really the goal is you get a daily update email that looks like this. It says, here's what's changed from yesterday to today. Conventional's up 0.04, high balance is 11 basis points, this, you can see generally what's happening. And oh, by the way, do you have any open touch points? What that says is, are you supposed to do anything with any of these clients? And that email, if that email says 0, then I can go do everything else that I need to do and I'm not missing something. But if it comes back and it says 1, because Ruby Johnson moved from yellow to green today, then either you can have it set up to be on full autopilot where that information automatically gets pushed to Ruby, or if you're more of a controlling person, you can say, hey, I want these things done in manual where I see them first, and then I look at it and say, yep, I agree with this. Yep, send Ruby the update. So either one, that gives the loan officer some control, but keep it simple. So that way it's pushed out to Ruby and she can see it. And maybe that's also the time that you get on the radio or your cell phone call text and say, hey, everybody out there's Albuquerque, or in this case, say, hey, Ruby, saw you went green today. This is usually when people have questions. What can I help with? Send. And then go, okay, now I can go do all my purchase business. I can go play with my kids. I can do whatever. I'm done with my refi work for the day because this has identified all my work for me.
Yeah,
Nice.
it's really great. And it gives you, it's just another resource for your borrowers too. So again, it's important to understand the ABM situation and the way that those models work and that they're not infallible. I am signed up. I've been using a system to send people an update telling them what their values are. I think it's once a month. I'm not entirely sure. And I get one too. And it's not right, but it's close ish, And
Just
also you'll know that too. You'll know that, okay, if this property is in a subdivision and every house is the same, then it is more likely to be dead on or close to it. But if if it's in Oakland and on this side of the freeway, the prices are this, and on the other side of the freeway, the prices are something different, you'll know that. So again, just an awareness that, you do have to think occasionally on these things, right?
Yes. And what do you want to be known to your clients for? Cookie recipes and batteries, or I'm your mortgage expert. So if the client looks at it and goes, hey, you know what, this value's, fill in the blank words, I don't agree with it. A lot of the times that gives them an excuse to reach out to you and say, hey, what's up with this? So it's like that gives you a chance to look at it and say, well, let me pour my expertise into this and re-demonstrate why you work with me and you ignore everybody else.
Yeah. We're constantly looking for reasons ways to make it visible how it is important to work with and actually.
So my own personal experience with this, I have been getting calls from clients, and I don't fit in the box for this because I don't do a lot of conforming, I do a lot of non-QM, just super jumbo stuff, and that doesn't quite fit in the box here, but it still is generating calls for me. And like the loan I just closed or signed on over the weekend, that when we were looking at my data, they were looking at my numbers and on the chart. And then the other loan I just got today, they're purchasing another property, and look, they've been clicking on my numbers. So it helps, even if it doesn't quite fit in the box, even if you're not just a conforming lender.
Yeah.
It
Even if
puts
they're
you in front of your clients.
percent where they're never going to refinance again for a rate term. Telling your client who's got a 3.5% loan or 2.5% loan that it's not yet, not yet, not yet. And that person's going to go buy another home. And let's say they walk into a builder and the builder says, we have our preferred lender. and they're going to go, hey, Mr. Preferred Lender, are you going to track my loan like Kevin's been tracking my 2.5% loan? Because I know I'm not getting 2.5% again. And I want out of this, whatever, let's call it 6.5, 7. I want out of that as soon as possible. So I liked Kevin's system. I want to go back to Kevin. And if you're not going to offer me that, then, that I don't want to, I really don't want to, I want to go back to Kevin.
Yeah, no,
It reminds me very much of, do you remember back in the day when Countrywide was just at the forefront of technology, and they were really one of the first lenders who had a website that the borrower could log into and see all the details of their loan. And I had people come to me and say, I want to use you, but I want them as my servicer. And I could close it on the correspondent side, and then it would be sold to them, and it all worked out and everyone lived happily ever after. So there is a lot to be said for, okay, what is happening after this loan closes? And the borrowers are becoming more and more aware of it. And we're really having to face it, because not only does Mr. Cooper have $8 gazillion in servicing, but now we have Rocket and what's their names, who just teamed up. And I mean, the servicing thing is going to be an issue for us. And again, just look at it as something that there is a need for us, but you're not going to just sit there and wait for it all to come to you. Well, unless you have this system, I guess.
And it will come. I mean, the system does predictions, so if the market gets 100, this dummy pipeline that I'm working with right now has almost $5 million worth of eligible loans. If the market gets 100 basis points better, that jumps to 9 million. If it gets 200 basis points better, that jumps to 17 million. So how do we get in front of those customers, stay in front of those customers? Because getting as much as we all hate the trigger leads, getting a trigger alert that says one of your past clients just had their credit pulled by another lender, that's too late. Your girlfriend just got asked out to prom by somebody else. You should have asked her first. At best, you're getting shocked. At worst, you're looking at the borrower's looking at you going, these guys called. I've already started the application with them. If things fall apart, I'll go back to you, but you lost first place. You're in second place now. So to me, that is not a good strategy to be reactive. You have to be proactive, because everybody else in the world knows, hey, start sending people at 7.5% junk mail. Hey, rates went down a little, start sending it to the people at 7.25. They know when your clients in general are in range, and your clients are going to get hammered.
Yeah.
A VA loan back in the peak of the refi days, we would get 3 to 4 pieces of mail a day, trying to solicit a refi out of us. So it's there. Everybody's sitting on the sidelines. When I was at Digital Mortgage last fall in September, all anybody was talking about was refi, because rates were coming down and the window was opening. And, we had somebody recently say, well, what if rates, don't come down? It's like, well, then that is just more pent up energy, because what goes up will eventually come down. So if we do keep going up for 6 more months or 12 more months, that's just another year's worth of clients that are waiting to be repeat customers. So lots of opportunity.
The rate projections, which we take with a grain of salt at this point, because they can go flying out the window over nothing, really. But regardless, they have been revised slightly. So and I think it was Fannie's chief economist who said that they're now projecting that we'll be at around 6.2 by the end of the year. They were at 6.3. So they're not suggesting that we're going to have a humongous decrease, but it is enough to move some people off the fence. And I would just like to say that I have yet another borrower who went into contract over the weekend. They're selling an investment property that they've had forever, and their interest rate on that thing is 3 1/8. And we are looking at an interest rate on a DSCR 1031 exchange of probably slightly over 7. So it's happening, people. People are making moves and doing things because they need to, they want to. It is not everyone stuck in the cog like they have been for the last couple of years. So just be out there and make sure that you are being proactive. So we have a question here. Is this a CRM or is it, what do you call this thing, Ken?
Great question. So I call this a bolt-on software. We are not trying to be a new CRM, new LOS, or anything else. We are a standalone, just do one piece of work really, really well and make it so that you don't have 42 hours of training or 17 hours of I need to set up my profile or anything else. It's literally hey, upload your loans. It's import via CSV. It's built around an enterprise, so you can see I can drill down by branch, I can drill down by loan officer, and the key piece is we need to be integrated with your pricing engine because we got to get the human being out of the process. The limiting factor we have right now is we are only integrated with Optimal Blue on the enterprise level as a pricing engine. We are looking at the loan sifters, the lender prices, a bunch of the other ones on the horizon, because once you have one built, building the next one is relatively simple. It's just a question of getting integrated with them and those details. And some of what I need is feedback of, hey, if 700 loan sifter customers said, I want this and I want this tomorrow for me, then I know that that needs to be the priority. And that's an opportunity for everybody to look at. And yes, as Kevin alluded to, it's built around conventional conforming VA, FHA, USDA, vanilla loans that pricing engines work well for. So you get into the non-QM stuff of, when was the last time this person, stood on one foot and, tapped their head and rubbed their belly at the same time. That's where you guys are superstars and will always have a job because those people need custom help. This is designed to be that loan officer assistant that you want to hire and train up and then never leave you. That's what this is it's already trained, it's already there. It doesn't complain, it doesn't need coffee, and it will never leave you. So yeah, it's built around all that fun stuff.
It's interesting too, because I was talking to someone the other day and they had a client who had done an arm with somebody 5 years ago. And I'm like, who in the hell did an arm 5 years ago when they could have gotten a 30-year fixed rate for, 2% or whatever.
Yeah.
And so just be aware that they're out there. So I don't know if those loan officers still exist, probably not, because I don't know how smart that was. But those people are seeing significant increases in their payments. And
Yes, they are.
They are definitely open for our input on whether or not they should refi. So, Ken, why don't you put your contact information in the chat? I think people can see it. Somebody said last week that they could see what was posted there. So, why don't you do that? I would just like to point out that Tony said that it would be great if I was president. I'm assuming he means of the United States of the whole world. And I would imagine there are a number of people shuddering at the thought. So that won't be happening. Yeah. Okay, couple of other things. So home price appreciation came out today from Case-Shiller and FHFA. Both of them were up slightly, but year over year, we're looking at appreciation of close to 4%. So
But wait, last week I heard that home prices went down in value.
they lied. Apartment list says that rents are up 0.5 month over month, down 0.3 year over year. But the vacancy rate went up from 6.9, which was high, to 7%. Those are high numbers. So it's going to help keep those the new rents under control. What were you going to say, Kevin?
I was going to say, so one of the reasons I'm able to do a purchase right now is because the clients realize that they can rent their place for enough to cover their rents, including the management fees and everything else, and buy another place, even though the rates are higher, move into that for the next few years. They have a job transfer they're working with, but it's like the numbers all work. They were able to keep their current house with a low interest rate, use the rent to cover the payments while they're gone, move into another state and buy a place there. And the math all worked perfectly. It was amazing.
Okay, so someone's saying that they don't think that the contact information is showing up. So if you would like Ken's contact information, just email me at audrey@mortgagepros411.com and I will get it to you. A couple of other things. buy now, pay later. Remember, we've talked about this over the last couple of years. It's not going well. So again, people are really struggling. 41% of them are late. Half of them are using it for things they really need. 25% were using it for groceries. So again, there is a need out there for us to go and check in with people and see, how are you doing? What are your blended rates on your credit cards and your car payments and all the other stuff that you have? Okay, so existing home sales in March, closings were down a little bit month over month. Annualized pace of 4.02 million units. And it's the slowest March since 2009. It's going to be interesting to see how the rest of the spring and summer go. We have seen some people pull back a little bit going, okay, well, the stock market just got hammered and now I don't want to, touch it, or I'm afraid. So there is some of that. But again, last week I was so busy with new inquiries. It was crazy. I mean, I'm still working on catching it all up. So it is, so again, the business is out there, and like I had a purchase go into contract over the weekend, and thank God I know about non-QM because I changed it. I mean, the last time I did her loan, I did a conventional, a paper, vanilla. And this time we're going to flip it to DSCR, and that's how we're going to get it done. She totally gets it. Had the conversation with her this morning early, and we're good to go. So make sure that you are really up on what else is available besides the vanilla. The other thing I want to say is I just talked to an attorney's office who just got hacked for the second time recently. And so as small business owners and as people who handle other people's private information, we have beaten this drum so hard, and still I know people haven't addressed it. Make sure you have security protocol in place within your business and your personal life. It is critically important. You cannot put it off. Let's see. You know how they give you the, this year versus last year on, okay, so sold over list price, we're at 21% of the properties sold over list price this year versus 29% last year. First time home buyers, first time home buyers, were 32% of the market, same as last year, and cash buyers were 26% of the market. So a little less than last year when it was 28%. Investors are 15%, again, same as last year, which I thought that was interesting. And so anyway, the bottom line though, is we've got appreciation. The inventories have gotten a little better. It's still not fantastic, but better. And there you go. Millennials made up more than a quarter of 2024 home purchases, 29% in 2024, according to NAR. And we're going to have Dr. Lawrence Yoon in a couple of weeks who's the chief economist for NAR. So we'll hear from him directly. But
one that you're going to have as your jobs report person when you become president, right?
Okay, we can all agree that would probably be a terrible idea, although, yeah, I do have some good ideas. Okay, baby boomers, okay, do not ignore the boomers because they are the largest generational share of home buyers right now, okay? So, I mean, some people think that they sort of faded off into the sunset and they're being replaced by millennials, not so much. So make sure you're paying attention to that, although a lot of them have cash,
And
surprisingly.
I have a quick question for Ken before we wrap up here. Ken, question from the audience. Are you going to be teaching any more VA loan specialist certifications for NAM or CAMP or anybody?
I don't do the VA side anymore, so I know Rick and Jeff are still crossing the country doing that for NAM. So,
Yeah.
but I do a lot of demos of this. So if anybody liked what you saw here and you have a boss that you think needs to see this, that's where go to our website of loautopilot.com, and there's a view demo and schedule a full demo, and we can set that up so that way you can set up your decision makers at your company or whoever it happens to be to say, hey, you know what? I think this would really help me. I think this would help a lot of the other loan officers around me. Let's do this because it's a win-win.
Yeah. My number one
They are the boss.
My clients are all replying when they get it is, wow, this is amazing. So
That's great. All right, kids. Well, I can't believe that it is time.
we went right through that.
That was quick. All
Yeah,
right.
we didn't even have to go into any war stories
So-
again and how he shot down 2 Russian MiGs while he was flying upside down.
So your website is loautopilot.com.
Yep.
That's
Pretty
it. Okay,
life
that's the
easier.
best way for him to reach you. LOautopilot.com. Guys, go get a loan.